Hello and welcome, everyone. I'm David Widmar with Agricultural Economic Insights, joining you for a chart of the week. We're going to spend just a little bit of time here talking about a recent article we posted on AEI and sharing a little bit of insights and helping you think about the implications for your farm and operation in agribusiness. Today, we're thinking about what's a reasonable expectation for farm level interest rates moving ahead. The Federal Reserve issues a quarterly projection of their participants' expectations. And in the December report, we noticed that the long run expectation for the Fed funds rate, that median value, had been increasing as up to 3%. So we wondered, if we start with that 3% Fed funds rate, what does that mean? And what does that translate into farm level interest rates? So we took a look at that. We took that 3%, we looked at historic spreads and say, what does that look like at the farm level? And one of the things we took away from this is there might not be as much downward opportunity in the market than what we might have initially thought. So in other words, if the Fed's going to cut those short-term rates by 100 or 150 basis points, those farm level rates might be slow to adjust downward. And some of this is because those farm rates didn't move up as quickly as the Fed funds rate did. One of the things that we noticed in this particular report when we were diving into it is, if you were to use those historic spreads to think about where are the Fed funds rates today, and we use historic spreads to think about what that might forecast for current rates, we see that the estimate is well above, almost 150, 175 basis points above where that sort of historic spread might be suggesting. And so the implications here today is that while interest rates are high, especially higher than what we want them to be, where those short-term Fed funds rates are, we might have expected even higher farm level interest rates. There's a couple examples here we mentioned in the article back in the late 1990s and in early 1990s, where the Fed funds rate was at a similar level in these high 4% area, and then we had farm level interest rates that were at or above 9%. So again, the challenge here is thinking about what are our expectations for interest rates in the coming years. And while the Fed has been signaling lower short-term rates, we've been talking about how long-term rates might be slow to adjust downward because of that yield curve inversions, and it might eventually uninvert itself. But also now we're thinking about this at a little bit deeper level, thinking about the implications for what historic spreads have told us and how the current farm level interest rate story is not as high as you would have thought given where Fed funds rates are. Until next time, stay curious.